Know the investment approaches available to foreign investors. Understand the meaning of various investment approaches available to foreign investors. Learn about three major approaches through which foreign investment can be made. Explain types of investment approaches in detail. Introduction. Meaning. FDI offers an exclusive opportunity to enter into international or global business, new markets and marketing channels, exclusive access to new technology and expertise, expansion of company with new products or services, and cheaper production facilities. Various examples of initiatives taken by companies to invest in India under FDI are Nikkei, which is one of the leading suppliers of athletic shoes and apparel, made an offer to the Department of Industrial Policy and Promotion to establish fully owned stores in India. Milacron, which is US-based company, also plans to invest around US dollar amounting to 30 million in 3-year span by setting up plants in Ahmedabad in Gujarat and Coimbatore in Tamil Nadu. Telenor Group of Norway campaigns to spend another 780 crores to boost up their ownership in Indian subsidiary Uninor to 100%. The economic growth can be boosted up by various inflows of foreign investment through FDI. To achieve that, government has taken various initiatives to promote FDI investments in India. Indian cabinet has approved a proposal where companies can invest in railways infrastructure through 100% FDI, but excluding the operations. That is, they cannot operate trains in India, but can do other things like creating network, supply trains for bullet trains, etc. On the basis of recommendations of FIPB, the Government of India has been continuously approving various approvals of FDI. The Union Cabinet has raised the foreign investment upper limit in private insurance companies from 26% to 49%, but with the condition that management and control of the companies must be with the Indian company. Major investment approaches. Various investment approaches available with foreign participants are: 1. Through registration with SEBI. FII can get themselves directly registered with SEBI. According to SEBI, there are certain parameters on which it will decide eligibility of a FII, like track record of applicant, their professional competence, their financial soundness, experience, journal reputation of fairness and integrity. As per SEBI, applicant should be in operation for at least 1 year. It is also checked whether applicant is registered and regulated by an appropriate foreign regulatory authority in the same capacity in which the application is filed with SEBI. To be registered with SEBI, Form A is to be filled, which is prescribed in SEBI FII Regulations 1995. As per SEBI, various documents which should be attached along with the application are: A. Certified copy of relevant clauses of Memorandum of Association, Article of Association or Article of Incorporation. B. Audited financial statement and annual report for the last 1 year. Period covered should not be less than 12 months. 2. Through participatory notes. PNs are also recognized as overseas derivative instruments. Equity-linked notes and capped return notes. Investors in PN do not possess the underlying Indian security. They are held by the FIs which in turn issue the PN. So investors in participatory notes get economic benefits of investing in the security without actually holding it. The values associated with participatory notes are linked to the underlying value of security. They are related to the fluctuations in price of underlying security. So any change in price of underlying security will affect the value of participatory notes. There are various benefits associated with the working of participatory notes because of it being attractive for foreign investors interested in taking an exposure in Indian markets. Some of these are: reduces transaction costs, provides customized tools to manage risk, lesser financing costs, enhanced portfolio yields, serves as a tool to hedging instrument. In order to supervise investments done using these instruments, SEBI has asked FIIs to report all the information regarding the issuance of participatory notes as well as sub-accounts on monthly basis, along with all the details of subscribers like name, location, etc. It is important to note that FIs cannot issue participatory notes to non-resident Indians, that is NRIs. And if they issue PNs to NRIs, then they are required to give an undertaking to the effect. 3. Through sub-accounts. According to RBI, sub-account includes those foreign corporations, foreign individuals and institutions, funds or portfolios established or incorporated outside India, on whose behalf investments are proposed to be made in India by a FII. In order to invest in India, FIs can do so by opening a sub-account. The sub-accounts need to be registered with Security and Exchange Board of India. For investing through sub-accounts, FI have to appoint a custodian, that is domestic Indian custodian, who is supposed to hold Indian securities in their custody. Custodians of securities have to be registered with SEBI. They are regulated by SEBI. Domestic Indian custodian have to constantly monitor as well as report about the investments as well as about the transactions made by FI to SEBI. Tax havens. Tax havens are those countries which offer individuals and business of foreign country freedom from tax liability either to 100% or to some extent, so as to promote an environment where countries can invest their money. This will help in promoting of stable environment in terms of political as well as economic environment. Countries like Bermuda, the British Virgin Islands, the Cayman Islands, the Channel Islands, the Cook Islands, Hong Kong, the Isle of Man, Mauritius, Liechtenstein, Monaco, Panama, Switzerland and St. Kitts and Nevis are called as tax haven countries. Tax haven countries not only provide tax benefits but also provide secrecy with foreign tax authorities, which encourage investment in such countries. But in recent times, it is seen that foreign countries are pressuring tax havens countries to enter into contracts like tax information exchange agreements and mutual legal assistance treaties so as to encourage sharing of information which was previously kept secret. Various approaches of FDI. According to a research paper written by Jose Guimon named Government Strategies to Attract R&D Intensive FDI in a global forum for international investment in 2008. FDI in R&D sector plays a very crucial role for the development of Indian economy. The author broadly categorizes them into two categories. A. Innovation policy. B. Inward investment promotion. Innovation policy. He says that countries undertake fiscal as well as financial incentive to promote FDI through R&D. They also undertake activities to develop human capabilities and attract foreign talent. Promoting human capital will help the countries to use their human capital to the fullest, thereby helping the countries to build a successful nation. Promoting innovation policy also enhances research infrastructure of the country, which also helps in promoting collaborations and linkages. This will boost the speed of growth of the country. Inward investment promotion. Countries undertake activities to promote R&D, which help them build image. They also undertake initiatives to promote investment and implementation of services. Not only this, they also emphasize on aftercare services. The paper also cites various examples of advertising as R&D location across European Union. For example, Germany, slogan used for it is land of ideas. Italy, log on to Italy. United Kingdom, want to be part of the UK cutting edge technological revolution. Ireland, knowledge is in our nature. Sweden, new ways of thinking. Denmark, creative Denmark. Spain, technology for life. Catalonia, Spain, look at innovation, look at Catalonia. Lower Austria, enjoy high performance in the high-tech business. Wallonia, Belgium, the pursuit of technological excellence. Portugal, technology from the heart. Czech Republic, the skills hub of Central Europe. Source, websites of inward investment agencies and advertisements published in various international business magazines and newspapers. Investment approaches in tourism industry. Tourism is one of the key sectors of the economy that help in the development of the country. Not only it is fast growing, but also labor intensive industry, which involves providing lot of economic activities, which further helps the country to realize economic gains. Promotion of investment strategies in tourism sector plays an important role for the development of the country. There is an increasing competition between various countries in terms of their tourism destinations. Countries nowadays are increasingly competing in terms of tourism destination and their efforts to promote FDI. All the countries are increasingly taking efforts to promote FDI so to attract more and more investments. Nowadays, it is not only tourism, but it's sustainable tourism. It means tourism activities which lead to preserving the environment and overall improving the quality of the environment. Not only this, it also includes overall improvement of the quality of the environment as well as tourism site. It also incorporates all the elements which make sure that tourists are completely satisfied and overall all the elements of society are benefited from the tourism activity. While talking about investment approaches, there are various approaches that firms can undertake to enter in tourism industry. Equity form of investment and non-equity form of investment are the two broad categories which firms can undertake while investing in FDI. Equity form of investment includes FDI and portfolio investments. Firms can also go for joint venture in which two or more parties undertake economic activity together. They pay for revenue, expenses and control the enterprise together. Non-equity form of investment includes leasing agreements. management contracts, franchise agreements, and marketing agreements. Mergers and acquisitions are also one of the popular approach used by the firm in tourism industry, especially in the service sector. They are not only quick, but also one of the efficient techniques of purchasing an already existing distribution system as compared to a completely new business. It helps to undertake the advantage of well-established business and market knowledge instead of starting from the scratch. Mergers and acquisitions are quite popular in the hotel industry. While talking about non-equity modes of investment, management contracts are quite close to FDI. In franchise agreements, control is one of the biggest issues. It is very limited. Though it is quite frequently used in the hotel industry, catering industry, travel agencies, tour operators, etc. In franchising agreement, franchisor provides the established brand along with use of its marketing tools, management system, as well as support of the business. In franchising contract, franchisee provides capital to the franchisor. But many times it is seen that FDI isn't so popular in the tourism industry. Firms look for these three factors before investing in any country. First being location, other being ownership, and last being internalization. Countries where the combination of three are found is ideal country. Ownership. It helps the company to compete with local companies. Location. Location factors like availability of market, cheap labor, etc. Internalization. These are benefits obtained from direct control of business. This framework is popularly known as OLI framework. Let us just have a brief look at various factors which enable or promote tourism investments. First is infrastructure and land, human resources, investment incentives like access to duty-free import of capital goods, equipments and inputs. B. Providing of training for locally employed staff, etc. These initiatives will promote tourism investment in an economy. Case study, Suzuki Motor Corporation in India. Amar K.J.R. Nayak from Xavier Institute of Management, Bhubaneswar, India has written a well-elaborated research paper on FDI model in emerging economies. Case of Suzuki Motor Corporation in India in the Journal of American Academy of Business, Cambridge in March 2005. In his paper, he has examined how automobile functions. Their investment needs are analyzed. Author also takes into account scenario of automobile industry prior to entry of Suzuki in India and also analyzes the nature as well as timing of entry of Suzuki Motors in India. Paper has also discussed about suitable and efficient model of FDI in Indian economy. For the purpose of study, author has analyzed date of FDI pattern of Suzuki Motors from 1982 to 2003 using reports of the company, government reports and various other secondary sources. Not only this, author has also conducted primary study by interviewing 10 key executives of Suzuki Motors and Government of India who were involved in investment of Suzuki Motors. The sample so collected was made sure to be reliable and was checked if it met the characteristics of entire population. In 1969, Sanjay Gandhi started producing small passengers car with name of Maruti Limited. Though it started with huge success, but it didn't succeed much. And in 1980, company was acquired by the Government of India and was renamed to Bharati Udyog Limited. Gradually, with the upcoming success of the company, management of MUL soon started to search for its foreign collaborator, which will help them provide with low-cost, fuel-efficient car engine of below 1000 cc. Various countries came but did not succeed with final negotiations. But finally, Suzuki Motors won the partnership of MUL with its attractive offer, and finally, on 2nd October 1982, the agreement was signed. Suzuki Motors faced many hurdles in its mission to make successful, cost-effective cars. Not only they faced poor infrastructure problems, which led to biggest hurdle in its way to build a successful, cost-effective car, but also faced major problem of using the Indian components in its production process. For the latter, Suzuki invested broadly in order to manufacture Indian components, thereby improving the quality of components and reducing the overall cost. The amount of intense commitment of the investment of Suzuki Motors is worth mentioning. Not only it invested huge amount, but also deputed its own human resources to manufacture cars as well as its manufacturing component. Roughly 7 Japanese employees were employed per year in manufacturing of cars. Not only did they employ their employees in India, but also sent Indian counterparts to Japan so as to impart them with skills, training on method of production, quality assurance, etc. Seeing success of Suzuki Motors, various other foreign companies like Nihon Gear, Nippon Denso starting their entry in India. They now saw India as a huge source of avenue of success for them. So we can conclude by recalling the success of Maruti Suzuki, which not only led to transfer of culture among both the countries, but also led to transfer of Japanese style of management practices among Indian companies. Japanese management features like quality cycles, employee participation in decision-making process, etc. have proved to be quite successful. Summary. This module helps us to understand investment approaches available to foreign investors and also the meaning of various investment approaches available to foreign investors. It can either be through registration with SEBI, in which FII can get themselves directly registered with SEBI, or they invest through participatory notes. PNs are also recognized as overseas derivative instruments. Equity-linked notes and capped return notes. Investors in PN do not possess the underlying Indian security. They are held by the FII, which in turn issues the PN. So investors in participatory notes get economic benefit of investing in the security without actually holding it. Or investor can invest through sub-accounts. According to RBI, sub-account includes those foreign corporations, foreign individuals and institutions, funds or portfolio established or incorporated outside India on whose behalf investments are proposed to be made in India by a FII. In order to invest in India, FII can do so by opening a sub-account. The sub-accounts need to be registered with Security and Exchange Board of India.